Hello everyone, welcome to our Law Excellence's unique initiative, Current Affairs for Beginners. Before starting our today's session, first let us see answers for the questions from our previous video. The first question is, Bank of Baroda announces swap ratio for merger with Dena Bank, Vijaya Bank. In this context, swap ratio means. We have seen what is meant by this swap ratio in our yesterday's video. It is an exchange ratio that is used in case of mergers and acquisitions. It is the ratio in which the acquiring company, whoever is acquiring the shares from another company, will offer its own shares in exchange for the target company's shares. So from the given statements, the answer here is A. Exchange of shares between acquiring company and the targeting company is the swap ratio. Further detailed explanation with an example was provided in our core notes. You can check that. The next question is, consider the following statements with regard to Comptroller and Auditor General of India. CAG audits transactions of union and of the state with respect to contingency fund and public accounts. It audits the receipts and expenditure of bodies or authorities which are mostly financed by the union or the states. RBI is also audited by CAG. CAG conducts audit on request of any bodies or authorities. Here this question is related to audit functions of Comptroller and Auditor General of India. The first statement is correct because CAG audits all the transactions of union and of the states with regard to the contingency fund and public accounts. And the second statement is audit of receipts and expenditures of bodies or authorities which are mostly financed by union or the states. This is also correct. And the fourth statement is also correct because it conducts audit on request of any bodies or other authorities. Then why the statement 3 is incorrect? Because RBI is not audited by CAG. RBI has an act, it has been established by an act of 1934. This act has an provision to have its accounts audited by special auditors of the government. So this audit of RBI is not done by the CAG. So the statement 3 is incorrect. So the answer here is B. 1, 2 and 4 only. These are our today's mains questions. You can find these questions in our today's core video notes also. Now let's start today's session. These are all the topics that we are going to cover in our today's video. Our first article is capital requirements for banks. This article comes under GS paper 3 under the topic of economy. In our previous video, that is on January 1st, one student has raised a question regarding prompt corrective action framework. There I said there are 3 parameters which will be the deciding factors to invoke PCA by RBI on the banks. And I said that among those 3 parameters, one is capital adequacy ratio. We have seen that if these parameters goes beyond a limit, it indicates the financial health of a bank has worsened. Then the student has raised a question that how this capital adequacy ratio impacts the financial health of a bank. Now let us see in detail about this capital adequacy ratio. Capital adequacy ratio is also known as capital to risk weighted assets ratio. So what is the use of this ratio? This ratio will measure a bank's financial strength. How it will measure? Based on 2 parameters. One is capital and the other one is assets. So what is meant by capital of a bank? Capital means it is a term for financial assets. These financial assets can be in the form of deposit accounts. We will go and deposit our savings in the bank. That is also considered as a capital of the bank because bank will use this amount to do its business. That means it will lend to its customers. And Here we have to know about two things. One is asset and another one is liability. Because a bank's capital means difference between the bank's assets and bank's liabilities. First of all, what is meant by these assets and liabilities? All the businesses will have assets and liabilities. Even an individual will have his or her own assets and liabilities. Individual assets means anything that the individual owns, like car, house, cash in a bank account. Those are all the assets of that individual. Liabilities in the sense the payments that the individual has to pay, like rent for his house or his car loan. All these will come under liabilities because he has to repay them. These are like the debt or financial obligations on the individual. It is same with that of business also. When it comes to a business, assets are considered anything that business owns. Anything that business owns in the sense the property owned by the business, that means the company or building of that business, is also considered as an asset. And liabilities are the financial obligations owned to another person or the business is called as a liability. Now, when it comes to banks' assets, banks have general assets and liabilities just like the individuals. So here, different types of assets for banks are physical assets like bank equipment and land or the building of that bank, and another assets were major assets were loans, and also interest from the consumer and business loans were also called as assets. Bank will have reserves. We have seen about capital reserve ratio and statutory liquidity ratio in our previous videos. We have also seen about government securities. All the deposits of central banks and other investments or securities were all considered as assets of that particular bank. Here now we are seeing about this loans. Loan is considered as an asset because it is the main business of the bank to lend to the customers, and that customer will return this loan, the amount which he has taken, with interest. This interest is the profit for the bank. So the bank's liabilities are payments for in case if the building that the bank is there is not the own building of a bank, then they have to pay the rent. And also customers will deposit their amount in the bank. For this amount, whenever the customers demand, they have to repay this savings of the customer along with interest. That is a liability, responsibility of the bank to repay to the customers. So here, what will happen if a customer who took loan from the bank and he fails to repay that loan? Then that loan will be considered as a non-performing asset if he fails to repay it within 90 days. So these loans which have gone out from the bank were considered as risky because we are not aware whether the person who took loan will repay it properly or not. So for every loan that was taken, a certain amount of risk that is a percentage number will be assigned to the each loan. The higher the percentage of that risk, that riskier is that loan. That means it is that risky to get back. So now the banks should have enough capital to overcome those kind of losses. If bank doesn't have that enough capital, then the bank will become insolvent because it is liable on the bank to repay back to its customers. If bank doesn't get back the amount which it has lent, how it will repay? So the bank will have to liquidate all its assets. That means it has to put all its assets under auction and it has to repay back to its depositors. So, we use this capital to risk weighted assets ratio to protect the depositors and promote the stability and efficiency of financial systems around the world. Because this ratio will measure bank's financial strength by using its capital and assets. Now let us see how this capital adequacy ratio is calculated. It is calculated by dividing the bank's capital by its risk weighted assets. I have said that every loan will be assigned with a percentage number. The higher this percentage number, higher will be the risk assigned to that particular loan. And this capital is divided into two types. One is Tier 1 capital and the other one is Tier 2 capital, divided by risk weighted assets. Now if we see how it is related to the financial health of a bank with higher capital adequacy ratio is considered to be safe and likely to meet its financial obligations. Because if we see here, at present, the Basel III norms has stipulated a capital to risk weighted assets ratio should be 8%. And in India, as per our RBI norms, Indian scheduled commercial banks should maintain a capital adequacy ratio of 9%. This is the limit up to which will indicate the bank's financial health is safe. If the capital adequacy ratio is below this 9%, then it indicates that financial health of the bank has worsened. In these kind of situations, RBI will invoke prompt corrective action framework, which are a set of guidelines to revoke the bank's financial health. And the most important thing here is who decides this ratio. It is not decided by the bank itself. It is decided by the central bank or a banking regulator in order to prevent the commercial banks from taking excess leverage and becoming insolvent in the process. If they were given the choice, they will start lending more and they will end up into insolvency. So to overcome this issue, it is the RBI who will fix this capital adequacy ratio. The next article is Graft Securing Funding Main Challenges for Startups. This article comes under GS Paper 3 under the topic of economy. From this article, we are going to see about a type of tax known as angel tax. What is meant by this angel tax? It is a 30% tax that is levied on the funds that were received by startups from an external investor. Not an investor who is a part of this startup, but from an external investor. From that funds, 30% of tax will be levied on those funds. Because that funding will be considered as and it will be counted as income to the startup, so that it will be taxed. The next article is e-way bill system changes confusing, says transporter. This article comes under GS Paper 3 under the topic of economy and the subtopic is mobilization of resources. From this article, now we are going to see about a concept known as e-way bill. What is this e-way bill? It is an electronically generated bill. E-way bill is a short form for electronic way bill. It is a bill that is electronically generated for the movement of goods from one place to another. That can be either interstate or intrastate. Interstate means within the state and intrastate means between one or more states. And that goods should be valued more than 50,000 rupees. If a particular vehicle is carrying or transporting a goods that are of worth more than 50,000 rupees, then this e-way bill has to be generated. This is required under the current GST, Goods and Services Tax regime. So when this e-way bill should be generated, this has to be generated before the commencement of movement of goods, before moving the goods. And validity of this bill is only for 1 day. For every 100 kilometers or above 100 kilometers, an additional 1 day will be provided. But within 100 kilometers, it is only valid for 1 day. So who will generate this e-way bill? When goods are transported by a registered person who has got registered under the GST regime, whether he is acting as a transporter in his own vehicle or hired vehicle or railways by air or by vessel, the supplier or recipient of the goods should generate this e-way bill if the goods are being transported by the registered person. When goods are handed over to the transporter, the e-way bill should be generated by the transporter. In this case, the registered person should declare the details of goods in a common portal. In case if an unregistered person is transporting, then either the recipient of supply or the transporter, they should generate this e-way bill. The next article is e-commerce rules don't allow FDI in multi-brand retail. Now let us see what are these new e-commerce rules that were issued by Department of Industrial Policy and Promotion pertaining to FDI in e-commerce companies. First, let us know the background about these e-commerce companies. These e-commerce companies, they can operate in two models. One is marketplace model and the other one is inventory model. Marketplace model means here the e-commerce firm, let us take Amazon, and this Amazon will act as a platform to connect buyers and sellers. There will be a buyer who will use this platform called Amazon to order a book or anything from this particular seller. So in these kind of companies, FDI is allowed. Now another one is inventory based model, e-commerce. Here the e-commerce company, let us take Amazon only. Here the Amazon itself will have inventory of goods that were sold on its portal, and it will own all those goods and it will only control those goods. In this kind of method, FDI is not allowed. So now if we see what are the new features are, here the vendors, the person who is selling, if he has any stake owned by an e-commerce company, then he cannot sell his products on that company's portal. In case, let us take a vendor. He purchased 25% of his goods that he wants to sell from this Amazon inventory only. Then he is not supposed to sell those products in the Amazon e-commerce portal, because here Amazon, as it is selling its goods to the vendor, it will have its influence on the price of the product that was sold on its portal, because it might give incentives. For example, let us take a book which is of worth 400 rupees, and if Amazon sells this book to its vendor at 200 rupees, and if the vendor sells this book through this Amazon platform only for 250 rupees. See the difference, 150 rupees, which will affect the book vendors and other businesses also. So for this reason, here the vendor, if he purchases his goods from that particular e-commerce platform, he is not supposed to use that platform to sell his goods. So here the Department of Industrial Policy and Promotion has not allowed foreign direct investment. Someone coming from foreign using the foreign currency and investing in India's e-commerce market to do business. FDI means the person will own it and they will have shares in it. They will have management authority also. They will acquire the ownership. So, in this kind of inventory based model, FDI is not allowed. Next article is Hope with the Concerns in 2019. This article comes under GS paper 3 under the topic of economy. From this article, now we are going to see about two things. One is current account deficit and the other one is non-banking financial companies. First, let us see about this current account deficit. CAD, current account deficit. We know that countries trade with one another to buy goods that are not produced in domestic economy. We will import goods if something were not produced in our country. So with the advent of globalization, investment within the country and in other countries has also increased. A country's trade and its economic exchanges with the world were recorded on an account, that is an external account, in the form of balance of payment transactions. This balance of payment has two components. One is current account component and the other one is capital account. Now in this article we'll see about this current account component. So before seeing this, first of all, what is meant by this balance of payments account? We know that usually our citizens and companies of a country will make several transactions with other countries. So these transactions are mainly of three types: trade in terms of goods, trade in terms of services, and capital transactions. This balance of payment account in India is a statement of all these economic transactions between residents of India and residents of rest of the world. Let us take that statement is take only for an year, in an accounting period, that is for 1 year. And this balance of payments account is classified into two types. One is current account transaction and the other one is capital account transactions. These current account transaction will involve export and imports of goods and services, whereas capital account transactions will involve flow of investable money to the country and from the country. Flow of investable money to India and from India. Now if we see the components that determine this current account are, this current account has two components. One is export and imports of goods, exports and imports of goods, and the other component is export and import of invisibles. Invisibles will also include services. So this invisible account will include services and also remittances. For example, there is some NRI from our family who went and who got settled there and who is working in abroad. Then this person will send back money to his parents or his relatives or his family who has been in India. That amount is known as remittance. This will also come under current account, invisible account transaction. Whereas this export and import of goods means exporting goods from the country and importing the goods which were not available in our domestic economy, that is purchasing from other countries. Under this invisibles, there were also some things like income, that is investment income, and it also includes like transfers, as I've said, remittances, gifts, donations, grants from other organizations to the country. And trade in services, we said that in the form of tourism. So what does this current account deficit mean? It simply means deficit on all these components. If export is lesser comparing to import of goods, then it is nothing but deficit on export and import, which means we are importing more than exporting less. We are spending more for importing the goods from other countries. And when it comes to invisibles also, deficit even here. If we are receiving less and we are repaying more, if we are giving donations, grants to other countries than getting in return, that is also a deficit. Now, let us see about this non-banking financial company. We have already seen so many times about this in our video. Non-banking financial companies are the companies that will provide banking services without having a legal definition of bank. It is not a bank, but it will provide banking services. This is incorporated in the Companies Act of 1956. This has a provision to establish non-banking financial companies. These companies will do businesses of loans and advances, acquisition of shares, stocks, bonds, debentures, securities that were issued by the government, that is the government securities, and they also deal with leasing, hire and purchase, insurance businesses, chit fund businesses. But these companies will not do any business that is related to agricultural activity and industrial activity. Here you can ask, who are the ones that will regulate these non-banking financial companies? These non-banking financial companies doesn't have one particular regulator. Based on different types of non-banking financial companies, they had different regulators in India, like RBI, SEBI, National Housing Bank. RBI will regulate the companies which will deal in lending, accepting deposits, financial leasing, hire and purchase, all these. Whereas a National Housing Bank will take care of companies who will give housing loans, home loans. The companies which take up stock brokering, merchant banking, all these will be regulated by SEBI. Whereas these Nidhi and chit fund companies were regulated by Department of Company Affairs. And most important thing, that just now we have seen that these non-banking financial companies, they serve the purpose of banks, but they are not banks. How? Because they have some differences. What are those differences? These non-banking financial companies, they cannot accept demand deposits. They can only accept time deposits. Demand deposits means now we have our ATM cards. Whenever we want money, we will go and draw from the bank. Whereas it is not possible in case of non-banking financial companies. And they cannot issue checks that were drawn on themselves. And there is no facility of deposit insurance for the deposits made in non-banking financial companies. And in case of banks, we had two provisions of cash reserve ratio and statutory liquidity ratio. The CRR is not applicable to NBFC, whereas an SLR of 15% only is applicable to non-banking financial companies. The next article is Go for Kadaknath Chicken, Scientist Advises Team India. This article comes under GS Paper 3 under the topic of Indian economy, and the subtopic is issues relating to intellectual property rights. From this article, we are going to see about a term known as geographical indication tag. What is meant by this geographical indication in India? Geographical indication is used on products. This is a tag that is given to a product which will have specific geographical origin and it should possess qualities or reputation because of this origin. Such a name will give assurance of quality and it should be distinctive, it should be unique, which is essentially attributable to its origin in that defined geographical locality. In our India, there were more than 300 products that carry this geographical indication tag. The first product which got this GI tag was Darjeeling tea in 2004. Now our Tirupati Laddu, Mahabaleshwar strawberry, blue pottery of Jaipur, Banarasi saris all were having geographical indication tags because of their reputation due to their geographical locality and quality of those products. So you can ask that for how many years this tag is valid? Is it lifetime? No. This tag is valid only for a period of 10 years. Later it can be renewed. From where does this geographical indication concept has emerged? This geographical indication protection is granted through TRIPS agreement. Our India is a member of World Trade Organization. So, India has enacted the Act to comply with the agreement on TRIPS. So, that Act is known as Geographical Identification of Goods, that is Registration and Protection Act of 1999, which will protect the geographical indications of India. Now let's see our next article. Improved light combat aircraft gets green light for production. This article comes under GS paper 3 under the topic of science and technology. And the subtopic is indigenization of technology and developing new technology. From the prelims point of view, from this article, now we are going to see about the particulars of or details of this light combat aircraft Tejas. Tejas is made in India with a single seat and single jet engine. It is a multi-role light fighter and it is considered as the world's smallest and lightest supersonic fighter. LCA Tejas, that is a light combat aircraft Tejas, is not the first indigenous fighter, that means which is produced in India, that is inducted into Indian Air Force. Before this Tejas, we also had HF-24 Marut fighter, which is indigenously developed fighter aircraft. This Tejas is designed by Aeronautical Development Agency and Hindustan Aeronautics Limited. As it is made under Light Combat Aircraft Program, it has begun to replace India's aging MiG-21 fighters. And this aircraft is equipped by satellite-aided inertial navigation system also. It has a digital computer-based attack system and autopilot mode. And it has limited reach of over 400 kilometers. This is its range and it will be mainly used for close air to ground operations only. Now let's see our today's prelims questions. The first question is related to capital adequacy ratio and the other one is related to angel tax. Which of the following statement correctly describes the meaning of angel tax? Try to answer these questions and post your answers in the comment box. Tomorrow in our video, we'll see a detailed explanation for these questions and we will also provide that explanation in our core notes tomorrow. And this is our Law Excellence website where you can access the notes for this video, and this is our official Telegram channel where you can access this video and its notes and also various other Law Excellence material. And for your convenience, students, from January 1st, we have been uploading notes link for this video in our description bar. You don't have to go even to our website or Telegram channel to access notes for this video. Just below the video in the description bar, you can have access to our notes. Thank you.